What's up, guys? Welcome back to our series on creating a trading plan. In last week's video, we discussed what a trading plan is, why it's important to have one, and then we got started identifying our trading goals and the investment instruments we'll use to achieve those goals. So if you haven't watched that yet, make sure you check it out by clicking the link in the description, as well as that like and subscribe button so you don't miss any future videos. So this week, we're going to continue building on that foundation we set last week by defining clear entry and exit rules. Entry and exit rules are crucial for several reasons. Firstly, they help you avoid making emotional decisions like entering a trade impulsively due to FOMO or holding on to a losing trade because you're afraid to be wrong. Having clear entry and exit rules allows you to make more rational and well-informed decisions. Secondly, having these rules can increase your discipline and help your consistency, which is especially important in this unpredictable and volatile world of trading. Every trader's goal should be to have a steadily rising equity curve going from that lower left corner to the upper right. Having these rules will help you achieve that and avoid boom or bust cycles. So with that said, let's get started with entry rules. Entry rules are designed to help you make informed decisions about when to enter a trade. And when defining your entry rules, it's important to consider what gives you an edge in the market. An edge is simply an advantage. This could be a specific chart pattern, an indicator signal, or something else. But once you've identified your edge, it's important to base your entry rules on that edge. So once you have your edge defined, you need to define what your entry point is and what signals you to enter that trade. Every time we enter a trade, we also want to know where our edge fails and where we should place our stop. This stop is going to be different than the exit rules that we'll go over later in this video. And then lastly, we need to put any miscellaneous notes, and we want to grab a screenshot of that entry setup. That way you can reference it later on. For example, one of the edges I use is an upside reversal bar, which is defined as the current bar undercuts the previous bar and then price closes in the upper 60% of the daily range. The next day, if price pushes above the high of the upside reversal bar, that would trigger my entry. The upside reversal bar would fail if price falls below the low of the upside reversal day, which would mean I would set my stop just a few cents below that low. Lastly, some miscellaneous notes. The upside reversal should occur near a potential area of support, which I then defined what those areas are. And then lastly, I have a screenshot of what this setup looks like. So as you can see, it's very important to go through this process for every edge you have. You really need to take the time, clearly define your edge, and then define what gets you into the trade, when it fails, and all those miscellaneous details. Let's go ahead now and move on to exit rules. So unlike the stop loss or where our edge fails that we just talked about with the entry rules, these exit rules are determining when to exit a trade to lock in profits or to exit if a stock begins changing character and showing weakness. So these are not the same as a stop loss. When you're defining your exit rules, they can be simple or they can be complex. For example, a simple sell rule could be at a certain percent gain, I'll sell half of my position and move my stop up to break even on my remaining shares. Or we can have something more complex, such as exiting a trade if price breaks above an upper channel line. Let's take a look at an example of what that might look like. We know what will trigger our sale, but let's define what the upper channel line is. So here I have it must occur on a weekly logarithmic chart. The trend line must be at least 18 weeks long, and it must connect to at least 3 points on the chart. And then I have a screenshot of an example. So with this, my trigger would be to sell my shares as price moves above that trend line. Now we're starting to make some real progress in our trading plan as we've covered our goals, what to trade, our entry and our exit rules. Next week, we'll dive into the important topics of risk management and market timing rules. Thank you for watching. If you enjoyed this video or found any of the information useful, go ahead, hit that like and subscribe button so you don't miss any future videos.